This is a quick orientation of the individual income tax return. The first section is the information block. The information block is name, social security number, address. Key to this block is the social security number. You want to make sure that's an accurate number and it matches up with the last names, especially if they were recently married. I've had times before where the social security number did not match the last name, whether it was married or somebody had, through identity theft, had already filed a tax return on them, which can slow the process down and cause a lot of problems for the individual. Next, we have the filing status. Here, we'll go over this in the first one of the first learning plans. Married filing joint is generally the best bracket, but then we move into another part of the information block, which is the exemptions. The exemptions, basically, that's yourself, your spouse, but the key to it are your kids. The kids, for each dependent you claim, you have the opportunity to take another exemption. It used to be a problem with social security numbers of the dependents, but that isn't anymore because generally you get the social security number when the child is born. Another part of this we'll go over in the class is there's a child tax credit for kids under 17. The next big section here is the income section. Here you're going to record all the income that the taxpayer received during the year. What's really common and you'll deal with mostly is number 7, which would be wages, salary. Those are reported on a W-2. You'll see a lot of interest income and dividend income. That comes from your investments. Usually another common one would be your Schedule C. That's for self-employed individuals. We'll work a little bit with Schedule C in this course. The other ones that you'll see is the unemployment compensation. It used to be a lot more common during the economic downturn. It's getting a little better out there. We will touch base a little bit about Schedule E. That's where your rental income comes from, and your reporting from partnerships and S corporations. Those are flow-through entities. You've probably heard about those in the news. Flow-through entities are reported and taxed at the individual level. Moving along, all of your income then is totaled up on line 22, and then from line 22, your total income, you get to adjust it. Most common that you're going to see while preparing taxes would be the educator expenses. That's for K through 12 educators. They get to subtract off. The government gives them a whole $250. They can subtract off against income. Another common one would be the student loan deduction, or excuse me, student loan interest deduction. And then anyone with kids in college, they might have tuition and fees. We will work with a bit IRA deductions and alimony, I believe, are in some of the problems we work with, but these are all deductions that we would take against income. That leads us to a key component that you'll commonly find with all the tax work that we're doing. That's something called adjusted gross income. Adjusted gross income, you probably heard it referred to as AGI. That is where it determines a lot of credits, phase outs, things like that. Line 37, your adjusted gross income, slides over to line 38. And on page 2 is where we start to calculate some of what your taxable income is going to be. You take your adjusted gross income, and then we start subtracting off the tax, or computing the tax and subtracting off the credits. Line 40, that's your standard deduction, or you might have heard of Schedule A. That's Schedule A is where people itemize. They subtract off their mortgage interest, their real estate taxes, and state withholding. Generally, those 3 are what make people or give people the ability to itemize. Next, we'd subtract off the exemptions. This goes back to the dependents section. You would subtract off an exemption for yourself, for your spouse. If you got 3 kids, now you get 5 exemptions. You'd subtract that off to arrive at taxable income. From taxable income, we're just going to skip right down to here. You would get to take credits away from your taxable income. Now, credits are very, very good because credits, excuse me, give you a dollar for dollar reduction in your tax. Because what you're going to do on this section here is you're going to compute your tax. Then from tax, you get to subtract off any credits that you can compute. The common ones that you're going to see are the daycare credit or child dependent care credit, and the child tax credit. That's a give me. The government gives you $1,000 per child under 17, and that has a very powerful effect on the tax owed. And the other one that we're going to see a lot of is the educational credit. That's going to be your HOPE or American Opportunities credit. And as I said, the dollar for dollar offset against the income tax is very, very powerful. Then you're going to arrive at your tax, and you reach a section here that I call the cash, basically the cash only section. These are additional taxes that will be added to the tax that you computed or have remaining there. That's self-employment tax. If you're Schedule C or sole proprietor, you're going to pay self-employment tax. It can flow to you out of a partnership. You also, a key to it is this one here. This is an additional tax on IRAs. If you tap into an IRA, or I should say cash out of an IRA, you're going to pay a 10% penalty on every dollar that you you take out. So that's going to add to this tax. That ends up with your total tax. And the reason that I call this the cash only is because the only thing that is going to reduce this line is the cash that you've paid down here in the payments line. This is going to be, you're going to use this line for the federal income tax that's withheld out of your W-2s. Here you have estimates that were paid. Certain individuals pay quarterly estimates to the government. And then down here, there are some refundable credits from above that you can use to offset your tax. And then once you get your total payments, it's either going to be plus or minus, oops, wrong way, plus or minus. You're going to either have a refund or you're going to owe the government. You owe it or you get a refund. So this is where you net out what your tax due or refund will be. Another important section to the tax return, and something that you're going to have to keep in mind, is this paid preparer. If you are paid to prepare someone's income taxes, you must sign. You have to sign it, or the IRS has very stiff penalties for you. They want you to represent that you are the one who prepared this person's tax return. They still have the ultimate responsibility, but they want to know who prepared the tax return. Another key element is the PTIN. That's your personal identification number. They stopped having preparers put their social security numbers on tax returns a few years back. Used to be it was right around the time of identity theft really rising. But your social security number used to be on every tax return you prepared, and you can imagine people take these to get credit all over the country, you know, to buy a house, to apply for credit cards, to apply for any type of loan, and anywhere they took their tax return, your social security number was going. So this PTIN's a great protector. You have to file annually to get this from the IRS. There's a $63 charge, but it's very, very worth every dollar when it comes to identity theft. This has been a quick tour of the Form 1040.